Welcome to the stock play of the day. Today's stock is going to be Skechers. We'll discuss should we pass or should we play. My name is Brian Overby. I am the senior options analyst at Ally Invest.
And I'm Lindsey Bell, chief investment strategist at Ally Invest. Brian, why don't we start by taking a broader look at the overall market? In general, all three major indices are in the green this morning, just ever so slightly, though. Right here you see, though, we have a chart of the S&P 500. This is a 3-month chart here. You see we're entering our 5th day of upside for the S&P 500 in a row. Year-to-date, on a year-to-date basis, the market's up 27%. We haven't seen that type of performance in a year through December since 1997. So I think the Santa Claus rally could be on at the end of this year. Today, what's driving action, though? We got some economic data that came out after yesterday's better than expected home builder index. It reached a 20-year high yesterday. Today we got more housing data, including housing starts and housing permits. On the housing start side, we saw that rise to a 12.5-year high. Permits were also up very significantly. Many believe that this trend that we're seeing a rebound in the housing market this year, especially in the latter part of this year, is really being driven by millennials coming of age. The American dream seems alive and well, and it could be good enough to drive us further into green territory as we enter into 2020. So those are kind of some of the big drivers of the market. Obviously, the Boeing story still is in the background. That really has an impact on the Dow more than any of the other indices. They announced yesterday that they're halting production of the MAX aircraft through the month of January. So, and that could eventually get extended. So there's still some concern there on that. But overall, that's my viewpoint on from a broader perspective. I also noticed, though, that today the VIX is down ever so slightly at about 12. What do you make of that level, Brian?
Right. Well, when you're looking at the VIX index, a lot of people discuss it as the fear index. And the fact that we see it down at the lower levels for the year, actually, all year long, we've had fairly decent volatility.
Right.
So that shows me a little complacency in the marketplace. Sometimes it's a little bit of a scary situation when people become too complacent relative to what the market is doing. And we remember what happened last year in December. We had one of the worst Decembers ever in general, but the market came bouncing right back. So I'm kind of surprised to see it at those levels, but that also just means that the rally is intact and that people are feeling comfortable with the markets and where they're at right now. So let's take a look at Skechers, today's stock of the day. We have about a 3-year chart here.
Yeah, and so I'll go ahead and dive into the fundamental story before Brian gets into the options action. What you're seeing here is the Skechers is at 41.55. It's just about where it reached its highs in 2018. So it's bumping up against some resistance there, and it's either going to go higher and shoot off to the moon like it did back in the end of 2015 over here, or we could see maybe a sharp pullback, perhaps with earnings in the early part of next year. We're not entirely sure yet, but I wanted to look at this stock because it was upgraded last week at the end of the week by Argus Research to an outperform rating. The analysts you see helped boost the stock on Friday. You see a big green line there. But the thesis that this analyst really has is that the company is seeing great growth prospects from overseas, mainly China and India. Wholesale sales are up and the direct to consumer are doing very well. They're also spending a lot of money to invest in stores overseas as well. So they're enjoying a little bit of popularity, and the stock is showing that right now. Also, what's been really impressive, not only the sales growth that these guys have seen, wholesale sales, by the way, up 22% in the most recent quarter, they're also starting to see gross margin expansion. And as a retailer, that's not so easy to come by. So that's really impressive. On the downside, though, SG&A, that store expansion is costing them. You're starting to see some of the operating income margin contract this year. Many analysts, including this analyst at Argus, expects contraction to continue into the next year. They're really expecting top-line growth to drive this stock continually higher into the next year. But when I look at it from a valuation perspective, Brian, it's trading at 17 times on a forward PE, price to earnings ratio basis. And that's a lot higher than the 15 times average over the last maybe 4 years or so. So to me, it looks a little bit pricey. It's banging up against resistance. like we said, it could go either way, but I'm interested to see what the options are telling us from your perspective.
All right, so let's look inside at the Ally Invest option chain. So one of the things that we always want to be aware of is the earnings date. We see that they announced earnings, as Lindsey mentioned, in October. So as far as earnings are concerned, they're not affecting the option prices. Now the stock is down right now. It's down about 12 cents. It's at 41.53. So it's a fairly inexpensive stock. Now one of the things about inexpensive stocks are the option premiums aren't quite as high. We look at the volatility here, and I'll just pull up the one chain that I have. If I look at the money option contract, and I'm just drawing my little arrow over to here on Lindsey's side, we're trading at about a 30% implied volatility. That's nothing that scares me as far as Skechers is concerned, but it is a little bit more of a volatile stock, and I think the chart kind of proved that to us. So here's what we're going to do. We're going to try to capture some of that premium. 30% volatility is worth selling. And we're a little bit sketchy. Do we think that Skechers is going to break out?
Sketchy with Skechers.
That works.
Sorry to interrupt.
So we think that it might break out a little bit to the upside. And if it does break out to the upside, well, there's some other interesting things that we can do. So right now, we're going to try to capture some of that volatility premium. We're going to be selling what's called a short put spread. This is a bullish trade in the marketplace, but it's neutral to bullish in that, in this instance, inside our options playbook, that's at optionsplaybook.com, what we're going to be doing is selling strike B. Now, strike B is the strike. It brings in the risk. We're selling a put right there. That's going to be a lot of premium that we're going to try to bring in. The stock is going to be above that strike price. Now, then we're going to buy strike A, and strike A is going to protect us. So we're going to pay less for strike A. This trade means that if the stock just stays where it's at, or if it drifts a little bit higher, we can capture premium and we can make credit just from time decay on the position. So let's see what that looks like inside the Ally Invest chains. You see here on the chains, all we got to do is we have over here on Lindsey's side, you actually see we have check boxes. So we're going to be selling the 40 strike put. Stock's at 41.5 right now. And then we're going to be buying as protection a lesser price option, the 38 strike put. Now, if we look at that on our Ally Invest workbench here, what we see here is the midpoint, and we can't always guarantee a midpoint fill, and I always got to say that this isn't meant to be a recommendation. We're just looking at this as a paper trade. But if we could fill at that midpoint, we could bring in about a 50-cent net credit to the account. So what does that mean on a short put spread? That's our maximum gain. That's the most that we can bring in. The width of the spread here, if we see it, it's 2 points wide from 40 to 38. That means that our maximum that this can trade for is $2. So if the stock went against us, went below 38 in this instance, well, then we would be at our max loss. Okay, so our max loss is that width of the spread, $2, minus that 50-cent credit that we bring in. So if we actually go to the trade ticket here in Ally Invest, we see that on the trade ticket, we're selling the 40 strike. That's our action here. We're selling that to open. We're buying the 38 strike. We see the net credit of 50 cents, and that's how we would want to enter this in the market. We'd want to work it a little bit. And if we were able to do that, our outlook for the marketplace would be, well, we really don't plan on making that entire 50 cents. If I can buy that trade back and I can close that out for a dime, maybe 15 cents, I'm going to do that. Why? Because we want a little bit longer in time. We want out 45 days in time. And if we can buy that back and get most of that net credit, we're going to do that. That also means that if the stock goes against us, if it runs, we're going to want to also close out that trade. The maximum we could make on the trade is 50 cents. I don't like to lose more than the maximum that we could make. So we're going to close this out if this trade is trading for $1. All right, well, I see we have some listener questions out here. Let's get to them right away. Lindsey, I have one for you to start.
Okay.
I'll start with this one. What's your outlook for 2020 after such a strong run in the marketplace in 2019? That comes from me, Stevie.
Sure. As I mentioned at the beginning of the show, the market's up 27% year to date. And a lot of people tend to think that when the market has that good of a run in 1 year, the next year, the market's not going to do it as well because it took it forward into the prior year. Well, analysis shows that that's not necessarily the case. Next year can still be a good year. It might not be as great as 27% or more, but it can still be up on average about 6.5%. That's going back to World War II. The index, when it's been up more than 20% in a year, the year after, you usually see on average a return of about 6.5%, and there's a pretty good recurrence there of that happening. So looking into next year, I feel pretty good about it, especially now that we're moving forward with China trade. One of the biggest issues that we're going to have to take into consideration as we plan out for 2020 really will be the election, because you do get a lot of volatility around that, which I'm sure you're very familiar with. So those will be kind of the two things, trade and the election, that we'll be focusing on, as well as the economy and how the improvement that we're seeing in housing, if that can extend into manufacturing, which has really been the weak spot for our economy here domestically. So the next question, there's more of them, and don't forget to submit questions below if you have any for us. Hornets fan 95 says, Brian, why did you choose a longer term expiration for your trade?
Well, that is an excellent question. I touched on it a little bit when we were talking about the strategy, but honestly, I didn't go into enough detail. The reason why we're going a little bit longer out in time is because we have a lower price stock.
Yeah.
When you have a $40 stock, you just don't quite get as much premium in the option contracts. Now, we were trading at an implied volatility around 40%, so it wasn't bad. I wasn't scared of trying to sell some premium. But if I have a little bit more higher price stock and maybe a little bit more volatile stock, I would have a tendency to go on a little bit shorter term expiration. Now, I also want to emphasize, and this is a great question overall, I don't plan on being in it for the whole 45 days, the expiration that we did. After about 20 days, I'm going to try to look to get out of this. You know, we're looking to see if this actual underlying is going to break out to the upside, and that's kind of our trade in here. So we got about a 15-20 day period before we're going to probably do something else with the underlying stock.
Well, I'm glad you're able to clarify that for us, Brian.
All right. Well, that's going to be it. Oh, let's get to the market recap here. So let's talk about the market index, S&P 500, Lindsey.
Yeah, and so I kind of talked about it there in the questions, but look, we have a lot of momentum going into the end of the year. Even though we're up 27% on a year-to-date basis, it looks like that can continue until the last few weeks of the year. We look to start 2020 off with a strong start. Now, talking about the stock of the day, Skechers, again, it was an interesting one to go through, talk about the fundamentals, talk about the options, which we'll cover. It's hitting resistance, though, and I think that is the most important takeaway from the analysis that we did today. So it could break out to the upside or the downside. What's your quick recap on the option strategy?
Well, on the option strategy, you mentioned the breakout to the upside or the downside. I like the concept of that. We're trying to bring in some premium to maybe buy a call later on. So if we do see that breakout to the upside, well, then we can use that premium that we made from selling the short put spread to maybe buy a long call at a later date.
All right.
All right. Well, that's going to be it for the stock play of the day. Please don't forget to click subscribe and ring the bell to make sure that you get all of the notifications.
And we will see you January 6th for the next show at noon.
Thanks for coming, everyone.